Welcome back to Gimme Some Truth. Today, I'm Clint Walkner. This is still Michelin. We're going to talk a bit about S&P 500 myths versus reality. I do have a little fun fact to open us up. The S&P 500, do you know when it was founded?
No, it's been a while, but I can't remember the exact date.
So next year, we're going to hit our 100th year mark in the S&P 500.
That's remarkable.
So it's over its nearly 100-year history since 1926. The S&P has delivered an average annual return of around 10%.
Nice.
So if you invested in it for the 100-year period, you could have thrown in $1,000 in 1926, and we'd be a little bit clocking in a little more than $10 million today.
Nice.
In your $1,000. So
that's beautiful.
Pretty good deal.
Yeah.
So if your holding period is forever, there you go.
100 years,
Yeah. A couple generations, though, if you think about it, think about the wealth.
Yeah.
That's pretty amazing. So we're going to go into and unpack some myths of the S&P 500, because I think because of how ubiquitous it is, we just make certain assumptions. And I think one of the big assumptions is that it's super diversified. You got 500 companies in it, so...
Right. How could it not be diversified, right? No, I think it's fair. And I think also it's become so prevalent in just the media. You can't open like a newspaper without seeing, the S&P 500. And so I think it kind of skews people's perception about what the index really is. And it's true that one assumption that people often make is that it's got to be super diversified, right? Because it is a representation of the market, right? So it's the market as a whole, and therefore it's a very diversified investment. But if you look under the hood at what's actually in the S&P 500 in its current form, it really isn't very diversified at all. And just it's not diversified on two very important levels. One is if you look at just the constituents, so the individual stocks within the S&P 500, the top 10, the 10 largest stocks within the S&P 500 represent about 40% of the index currently. So even though there are 500 stocks, that is true, the distribution of those stocks, the weight of the stocks within the index is extremely, extremely skewed, extremely concentrated around ultimately a very small number of names. So that's an important factor to consider. There's another, it's also concentrated from a sector allocation perspective, right? So if you look at the S&P as a whole, there's a bunch of different sectors within it, ranging from energy, healthcare, technology, and that covers the entire economy. But again, if you look at the weight of each individual sector, there's not that much diversification because it's heavily, heavily concentrated around technology in particular, right? So if you look at technology and the allocation to technology within the S&P 500 currently, I was looking at some data. If you look at just technology, it's about 36% of the S&P currently. But I would argue that even that doesn't really tell the full story, mostly because the way that sector classification currently works is that, Google and Meta are supposedly not technology companies. They're actually categorized as something else, as, communication services, right? Along with, companies like AT&T and T-Mobile. I think you could make the case that Google and Meta are actually technology companies. And if you, brought them back into technology as a sector, really technology would represent closer to about 43% of the index.
Well, and add Amazon back to that too.
Yeah. You could really start having some fun with that, right? Yeah. And these are not crazy ideas, right?
So, is it safe to say that the S&P 500 is really a gigantic mega cap tech iceberg?
Yeah, absolutely. I think it's a very specialized niche index in many ways, and it doesn't make it good or bad. It's just you need to be aware of what it is. And that's why, if you think back to earlier in the year when we had extreme volatility back in April because of tariffs and all that stuff, people were horrified and in disbelief that, the S&P 500, that the market could behave the way that it did and, lose 10% in a day or something. But if you look at what's actually in the S&P 500, it might behave a lot like a, single technology stock, because, a lot of the constituents, really what's really in the S&P 500 is driven largely by a small number of technology stocks.
And think about what would happen if we had a huge shift in the AI narrative and all of a sudden it became a negative story, and all of a sudden the pullbacks happen in that. How much ramification would it have in the S&P 500? It would likely be pretty massive.
Oh, it would be huge. It would be huge. And it works both ways, right? I mean, it's been a great investment in recent years, and part of it is the AI craze, and we'll see how that develops. But certainly in terms of, themes and factors, it's a very concentrated play on technology.
It's not a good or a bad thing, but you should be aware of it. So let's get into a second myth that we have here. It's a good reflection of the U.S. economy. I think that's very interesting, because it's a situation where the S&P 500 is a lot more global than people realize.
Yeah, absolutely. And I think, our politicians are probably partially to blame for this myth, because every, administration likes to take credit or point to the performance of the S&P 500 as proof that, the U.S. economy is incredibly strong. But it's also true that the S&P 500 is not, I don't think it is the U.S. economy. I don't think it's really a good proxy or a good reflection for the U.S. economy. And I think part of the concentration story and part of the reason why, these large mega cap tech stocks represent such a large portion of the U.S. stock market is because they're huge global multinational corporations, and they've been more successful at international expansion than a lot of other listed companies. And in some ways, they've become bigger than the U.S. and they operate on a completely different scale than a lot of more U.S. centric companies that are listed in the U.S. Right. So I was looking at some data from FactSet this morning, and they estimated that if you look at the S&P 500, about 41% of the S&P 500's revenue originates from outside the U.S. 41%. So that's huge, and it shows you that the S&P 500 is not just the U.S. There's a lot more to the S&P 500 than just the U.S. And I think that has some important implications, and it's can be both good and bad depending on how you look at it. I think if you were very bullish on the U.S. and you wanted to play a theme around the U.S. consumer or the U.S. entrepreneurial spirit or something like that, you probably wouldn't go to the S&P 500 as the best reflection of those themes. I don't think you would. At the same time, if you think back again to like the market freak out earlier in the year when we were having discussions with people who were like, oh, should we get out of the U.S.? Should we sell all U.S. assets, for example, right? The reality is if you sell, some of the large U.S., mega cap tech companies, you're selling companies that are not just present in foreign markets, but they're leaders in some of the markets that you're actually trying to get exposure to, right? So I think those are some important considerations.
One of the other myths that I've seen here, and sometimes it's in the Boglehead group or sometimes in certain Reddit groups, people that want really simple portfolios, and they're like, the S&P is the only investment that you need on the equity side.
Yeah. No, and it's true. And it's as a sort of, especially if you're a DIYer and you're a minimalist and you're looking for a very simple formula, this idea of just buying the S&P 500 and waiting is very appealing. And, in fairness, it's worked great in the last few years. So, why not? I love it. At the same time, it's like a lot of things investment related. it's going to work until it doesn't, right? We saw this year that it hasn't worked that well in relative terms, right? The S&P 500 sure is up this year, but it's far from being the best performing index. And actually, you would have been doing much better if you were invested more broadly, including in overseas markets and things like that. And also, I think, and I mean, you and I are kind of dinosaurs in the sense that, we were active in the investment industry before the 2007 crisis. But, this whole theme of U.S. and mega cap outperformance is relatively recent, right? I mean, it really goes back to maybe the post-Great Financial Crisis era, and the start of quantitative easing in the U.S. is when you started really seeing this pattern of very consistent U.S. mega cap outperformance. Prior to that, if you look at market history, it wasn't really true. And it was very common to see things like small caps or value stocks, right, or emerging market stocks outperform. And it's true that nowadays people have become used to just the U.S. large caps being just the best performing index by default. A lot of investment professionals have never worked in an environment where that wasn't the case, and so it's kind of this feedback loop where people assume that it's always going to be the case, and certainly market momentum has validated a lot of these opinions. But at the same time, I think if you take a broader perspective, a more long-term perspective, not just looking at the last few years, but if you take a kind of 20, 30, 50 year perspective, this stuff is going to come and go, right? And you're taking a lot of risk by betting on an index that at the end of the day is fairly high risk, fairly concentrated. So if you want to express a view that the next 10 years are going to look exactly like the prior 10 years, and certainly you would want to be in the S&P 500. But certainly if things change and market dynamics evolve, then some of the risks and the limitations of the S&P 500 as an index are going to be very, very obvious.
Yeah, I mean, if you back up over certain periods of time, I remember when I was in the industry, 2000 to 2010, far different.
Yeah,
right now,
decade, right?
Yeah. And right now we kind of have that S&P 500 forever sort of mindset in there. And you're absolutely right about emerging markets are not represented. Value is woefully underrepresented now because that index is tilted so far in the growth side that we just don't see, value being represented in the amount that it probably should if we were looking at a truly diversified portfolio. If you're going just momentum, maybe you don't need it, but there are definitely periods of time where value will come back into favor, particularly in down markets. And I think it behooves you to have some of that in your portfolio. Yeah. And we're missing a lot of small caps, and I think small caps perhaps over the next 10 years might be a little bit more of a friendly asset class if we look at that. It's just had kind of a rough go and everything's been mega cap.
I agree. And I think that goes back to the myth that we were talking about just earlier about the S&P being a good representation of the US economy. And that's another reason why it's not. It leaves out a lot of what's going on in the small cap world. There's even a broader point that you could make about, the fact that, for example, nowadays in the US, a lot of companies are staying private longer. So, it's not just about the S&P 500. It's also about just, it's I would say questionable whether any listed stock index really is a true reflection of what goes on in the US economy, because the vast majority of companies, and even if you consider larger companies, companies with 100 million plus of revenues, the vast majority of them are actually still private, right? And even if you think about tech, some of the most exciting and fastest growing companies like, OpenAI and Anthropic, these are all private companies, and they're companies that are, likelihood going to stay private for a very long time. So there's a lot more to the US economy than, just the S&P 500. And if you invest just in the S&P 500, you're missing out on a lot of different things.
Yeah, exactly. Well, Sil, thanks for bringing some light to some of these common myths for yourself. Look at your portfolio, see how much S&P 500 exposure you have. Send us some questions, meet with us We'll be happy to discuss your own personal portfolio and where you're at and where your exposure is at. And thank you for joining us on another episode of Gimme Some Truth.
Walkner Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit walknercondon.com.